Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 26th of June. I'm Daniel Lam, your host for the podcast. I would like to switch gear today and talk about ESG investing in the Asia region. This topic has been specially featured in our second half outlook, which we published last Friday. Empirical research shows a positive correlation between broad financial performance and ESG factors, especially in emerging markets. In our view, this positive correlation is underpinned by two long-term drivers. First of all, sustainability opportunities are aligned to Asia's growth, and strong ESG credentials protect companies against business risk. Now, in past decades, the effort to lift Asia out of poverty was fueled by growth at all cost policies, which is increasingly unviable. Governments are now focusing on sustainable growth, resulting in a rich set of opportunities for ESG investing in Asia. Asia's low-carbon transition continues to enjoy structural tailwinds as more governments step up their net zero commitments. In fact, almost two-thirds of the renewable power built globally in 2020 was in Asia. Asia has now emerged as a key producer of critical components for the shift to a low-carbon economy, such as EV batteries. Now, beyond climate, there are also growth prospects associated with social needs in the region. For example, growing affluence has led to demand for healthcare, and financial inclusion for the underbanked is also a positive driver for the financial sector. Regulators can also act as a tailwind for ESG investing in Asia. Policymakers have increasingly been making it more costly for companies with poor ESG management to operate. This has, in turn, driven companies to accelerate their ESG implementation. Now, in Asia, investors are in an advantageous position given a relatively higher number of firms with room to improve on their ESG profiles. Better ESG track records can unlock access to lower cost capital, enhancing financial performance over time. Conversely, companies with poor ESG practices might be penalized and potentially excluded from portfolios. Now, that said, ESG investing is not without its challenges. So first of all, the lack of standardization in ESG disclosure makes it challenging for investors to make comparisons across companies in the region. Also, there is a lack of meaningful ESG data in non-core asset classes, in particular sovereigns and private assets. This makes it challenging for investors to incorporate ESG considerations into their multi-asset portfolios. In summary, though, despite the recent bumps with ESG investing, we continue to believe that a focus on the material ESG factors and relevant sustainable themes in Asia will have a positive impact on investors' portfolios. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.